All right, good morning to the hockey family. It's Monday, August the 10th, 2026. Hope everyone had a nice weekend. As I mentioned, I think in last week's video, my kids start school. They start so early down here. They start school tomorrow. So this morning, my wife was up, like shaking them, trying to wake them all, just get them a little bit more acclimated to waking up early. I would say kind of mixed results at best with her effort. The kids were dragging a little bit, but they got to get up and at it here. They're not going to have the option tomorrow. So, but we hope you had a nice weekend. Gosh, I mean, summer flying by here. So on that note, we'll start reaching out here for some preseason reviews, just making sure things are where you need them from a cash flow perspective and things like that. Kicking off the year here, so we'll be reaching out soon in terms of setting up a quick preseason review for each of you. Looking at markets last week, another strong week by and large for global equity markets. Mostly driven by continued just impressive earnings. I say somewhat surprising, but just the earnings have just been much better than expected. As well as Friday, we received actually like a weaker than expected jobs report, employment report. All right, so Friday's jobs report in the U.S. showed an unexpected contraction, so a net loss of 20,000 jobs. All right. And so that 20,000 loss of net jobs brought down the 3-month average. So you just look at kind of the trailing 3 months to, so the last 3 months, now we're looking at only an increase of 20,000 per month, right? Which is not great, which puts the Federal Reserve in a bit of, a tough spot because they're what they call a dual mandate, the Federal Reserve. They're supposed to balance like employment as well as inflation. And as we've discussed on a handful of videos here, right, inflation has been running a little bit higher than they like, right? So kind of 3.5%. Their target's 2. So like inflation's a bit higher than they like, but employment's been really, really strong. And so, but now you throw in this report that wasn't great. And what's neat about markets, at least for like huge market nerds like myself, is you can actually quantify, right? So through the Fed futures, you can actually quantify the probabilities of like a Fed rate hike or a rate cut here in the US. And it's just amazing how quickly markets react. So going into that jobs report last week, so the futures market was implying a 67% chance that the Fed was going to hike interest rates in their next meeting in September next month. All right, so 67% was the probability. And then that data gets released, the jobs number last week, and almost immediately that future rate went from 67% probability down to a 42% probability. So now currently as it stands, but less than a half, so 42% chance that the Fed raises interest rates next month. But then again, markets are always changing because this week we have an important inflation number on Wednesday. All right, so consumer price index CPI, that number gets released on Wednesday, and so probabilities will probably change again. It's like employment, inflation. It's the fun stuff we get to look at here. I think it's fun. Many of you probably don't. You're better at playing hockey or coaching hockey or all the fun things that you get to do. But all right, we hope everyone has a great week. Enjoying the rest of summer here with family and other loved ones, and we will talk to you soon. Thanks.